Financial dividend stocks are the topic of today's presentation. And you may be wondering why we've been covering dividend stocks so much lately when we largely cover disruptive technology investing. So let's talk a little bit about that. Why do we run this YouTube channel? The main reason that we even take the time to produce these videos is to sell a great financial subscription offering. I'm going to put on my sales hat here for a second. How do you create something great? Well, you listen to what your customers say, and that's what we did here. All our products, reports, and services were developed based on paying customer feedback. How do you know that what you developed is great? Well, people tell you, so that helps validate our offering. Most recently, our paying subscribers have asked for a new money portfolio. What does that mean? Well, when somebody subscribes to our subscription offering, the first thing usually they want to do is find out what we've invested in, and more importantly, what they should invest in. And when you have a portfolio of stocks, the market will evolve, and you may not invest in the same way later on down the road. So the idea here is that we pick 10 technology stocks that we believe are most compelling right now, and that list shouldn't change. That's the idea, is that it shouldn't change every 5 minutes, so we'll probably update that twice a year. And then 10 dividend growth stocks. To answer the question, if you were going to invest in 20 stocks today, what would those be and why? So we're in the process of picking 10 dividend growth stocks, and to do that, we need to do more research, and that research manifests itself in the form of some dividend videos that you've been seeing on this channel. So let's talk about 10 dividend growth stocks. Our Quantigence universe, so that's our dividend growth investing strategy that we have here at Nanalyze. Paying subscribers get access to that report. That has over 70 stocks that we refer to as dividend champions. We did a recent video on aristocrats. There's no difference between the two except that aristocrats are found in the S&P 500. Now, we're holding 30 dividend growth stocks. That was our decision when we created that portfolio well over a decade ago, and that will obviously differ from the set of 10 best DGI stocks that we're trying to produce. So we can make some assumptions. One is that there's 11 sectors now that I think this was several years back, decided that real estate should be an independent sector. So then you have 11 sectors, and we need to pick 10 stocks. We can't exactly pick one stock per sector. That's not going to work. So let's think about these sectors. Do we really need tech stock representation when this 20 stock portfolio, half of it is disruptive technology stocks? No, we don't. So we can drop tech off, and there aren't that many interesting technology dividend growth stocks. We did a recent video on that covering that very topic. The other sector that we're questioning would be REITs or real estate. Wouldn't most people already have property exposure? And the answer is probably yes. So of the sectors remaining, we'd like to have some exposure to each if that makes sense. And one of those sectors is financials, what they call financials, and that's actually quite broad. So if we look at our report, we see there's 9 stocks to choose from, and we've ranked those by Q-score. That's a proprietary score we developed that considers 7 factors like years increasing dividend, market cap, yield, growth, payout ratio, and the like. Things we want to consider here when we're thinking about picking a financial dividend stock. First would be subsectors. So financial is a very broad label. Second would be yield. Since this is an income portfolio, we want to have some income. We want it to be easy to follow. Any stock that we would find compelling and communicate that to subscribers, it would have to be something that people could follow themselves. They shouldn't require an interpreter who publishes twice a day on Substack explaining how a business works. It needs to be easy to follow, and there needs to be a high likelihood that the dividend growth is going to increase into the future. That's what makes this strategy so compelling. One thing we're not going to consider is performance. That's backward looking. It's entirely impossible to guess which stocks will outperform going forward. People often ask that question. We don't know the answer. So when we look at the top 4 stocks in the financials grouping here, as I said, there's 9. We've just taken the top 4 here, and we're going to choose from those that have the highest Q score. That's the field there on the far right. we have some names here that are interesting. Aflac is in first place. Then you have S&P Global. Then you have Franklin Templeton and T. Rowe Price, what Franklin Templeton is now referred to as Franklin Resources. So when we look at these four firms, we can start to break them down into subsectors. Aflac's in insurance. S&P Global is a provider of multi-asset class and real-time data, research, news, and analytics to institutional investors. Franklin Resources and T. Rowe Price Group are asset managers. They manage money for institutions and retail investors. Let's start talking about the insurance business. It's very compelling. So Buffett loves the insurance business, he said before, because the business model is so eloquent. You collect a whole bunch of money from people. You invest all that money, what's called the float, to realize a return on your investment. Then you pay as little out of that as possible. Then you enjoy investment income that you receive using that float. Hopefully you're investing and realizing a profit if you're responsible. And then you also enjoy the underwriting profit. So when you wrote that insurance policy, you should have written it such that in the majority of cases you'll receive more money from the client than you will that you have to pay out. If you put yourself in the shoes of an insurance company, then you start to understand why they challenge your claims the way that they do. Now, Warren Buffett has over $100 billion in float that he uses to generate wealth with. But we've asked some questions here in this piece. This was about 5 years ago, how technology will affect big insurance companies. It's really a double-edged sword for the insurance industry. So if you think about auto insurance, what's self-driving technology going to do to the auto insurance industry? It's going to decimate it. But on the other hand, how will AI algorithms allow us to more accurately underwrite policies for a profit? Well, that's something that a number of insurtech firms are doing that we've covered, publicly traded stocks, some of them. But you can bet that the larger insurance companies like Chubb and Geico and all those are focused on using AI to better underwrite policies. Now let's get back to talking about Aflac. What most people don't realize, it's rather remarkable, is that Aflac predominantly operates in Japan. So they're the number one provider of cancer and medical insurance in Japan. You can see here this breakdown of the types of insurance they're offering: life insurance, medical, and cancer. And when we look at Aflac's income, so that's the money that goes out and paid to shareholders in the form of dividends, 70% of that income is from Japan. And this article, the lower left here from the Wall Street Journal, talks about the three-pronged hedging program that Aflac has to hedge against the movement of Japanese yen. On the right here, you can see how Japanese yen is approaching another record low against the U.S. dollar. So if all your income is in yen and then you need to translate that to U.S. dollar, then you're essentially losing money. Thus, the importance of this hedging strategy, but hedging strategies cost money. Now, the reason that we wouldn't pick Aflac, even though it has a very high Q score, we wouldn't pick this as a top financial dividend stock because of its heavy exposure to Japan. You might ask the question, well, how much exposure to Japan should a retail investor have? Well, the upper left here, you see the MSCI World Index. So these are all the developed markets in the world broken down by market cap weighting. So clearly the U.S. is dominant there at 65%. Japan in second place at 8%. So if you had a portfolio, the maximum amount of exposure you ought to have to Japan would be 8%. Anything over that, you're overweighting that country. We don't want to overweight Japan in our portfolio. So Aflac would be a firm that we would pass on. That brings us to S&P Global. This is one of fewer than 25 companies in the S&P 500 that's increased its dividend annually. Increased is the key word there, for at least the last 50 years. That's remarkable. Now, the problem with S&P Global is that the yield is under 1%. It's very low, and we penalize that in our strategy. Another way to put this would be that if the stock price halved, which seems extremely unlikely, the yield would still be under 2%. It's one of three companies that we're holding where the yield is penalized. So we'll penalize yields below 1.5%. Why do we choose to hold it? Well, when we looked at this sector, we wanted to pick one firm from each of the three subsectors: insurance, financial services, and asset management. That's the approach that we took, and this is what we picked for financial services. Now, this is a good segue into higher yield opportunities in asset management. So we're going to pass on Aflac, we're going to pass on S&P Global. That leaves us with two names: TROW versus BEN. Now, when you look at the factors here in our quantitative strategy, you see how similar these two firms are. It's remarkable. And of course, that Q score will change over time. It doesn't change very much, which is one of the beauties of this strategy, but it will change. So you can't use that, especially when it's this close, as your sole basis for making a decision. So in our report, we made some comments about BEN, and these are the comments we said. BEN seemed to be running into problems growing its business, and the stock was sinking like a rock. This is less of a concern given their acquisition of Legg Mason in 2020, but we still find BEN to not be overly transparent when it comes to communicating their strategy. We'll talk about that. And also note that both BEN and TROW pay a special dividend. We don't take that into account into our Q score. So that's not calculated here for yield because it's a one-off dividend. And we said it's something we're considering as we further refine our quantitative methodology. For right now, because it's special, we're not considering it, but it's meaningful. Here you can see, this is a great depiction by this financial services firm that provides this data of special dividends for BEN and TROW. BEN on the left, you see those spikes? Those are special dividends. And you see TROW, less special dividends over time, but more meaningful. So that, for all practical purposes, I remember the last BEN special dividend. We've been holding BEN for a long time, and that was a meaningful amount of money relative to their dividend. You can see the bar right there, and that was very noticeable. I think at that time, we were still reinvesting dividends for this strategy, so they just went right back into buying more shares. But these are noticeable bonuses if you're somebody that's relying on these firms for income. Now let's get into BEN versus TROW a little bit. And this is an excellent slide. On the left, you see BEN. This is their diversification. So they have assets under management of $1.43 trillion, a lot of money. Not relative to the largest asset managers out there, but still a large chunk of change there. Look at asset class. So cash 5%, multi-asset 10%, alternative 18%, equity 32%, fixed income 35%. They're very well diversified across asset classes. Then you look at client type. Well, about half to retail, half to institutional. Fair enough. Then region. So 72% is in the U.S. and the remainder across the globe. Now look at TROW price on the right. 91% of their assets under management are in the United States. 52% are equities, so they're overweight equities, overweight U.S., and they're having some problems. You can see the table in the bottom, firm-wide flows by quarter. This is how this works, all right? When you're an asset manager, you want to manage as much money as possible because you're charging fees on that money, and that's how you run your business. If say every quarter, some clients are going to pull their money out, say, I don't want to invest money anymore with you. Not totally, but maybe some money. And then some clients are going to say, you know what, here's some more money I want you to invest. It could be new clients or existing clients. The net of that is what TROW price here refers to as firm-wide flows. So look at that. 14 billion, 24 billion, 17, 16, 20. Those are all negative numbers over the last 5 quarters of outflows. So the outflows exceeded the inflows, what's called net flows, and they're losing money that they're managing. Now, when you say, well, why isn't assets under management decreasing? Well, the assets also increase over time or decrease. So you can see that this firm is leaking their assets under management. And sure, these are small numbers of outflows relative to the total amount that they're managing, but it's still notable. This is a key metric for an asset manager. So we want to understand that a little bit more, and we can look at this other slide from TROW that shows the net flows. You see along the bottom there, so now you can start to see, well, last quarter, for example, they had $20 billion in outflows for equities. But their multi-asset class strategy, that brought in some. And then you can look at the flows by institutions and retail, so the majority was from institutions. And then over on the right, of course, most of the outflows will be from the United States because that's where most of the money is being managed. So this kind of gives you some insight into where those flows are, the reasons for those net outflows. Now, of course, over time, the situation will change. T-Row may have some good quarters, they may have some bad, and the same with Ben. That's why it's important to look at the overall strategies. And these charts here are taken from Ben's most recent quarterly report. And I want to draw attention to the first sentence here where they say, in a period of market volatility, we continue to make good progress on the execution of our long-term plan of further diversifying our business across asset classes, vehicles, and geographies. Love that. And that was reflected earlier in that slide that showed how Ben broke down their assets under management fairly evenly, or at least more evenly than T-Row when it came to asset classes. And this trend here is good. So on the left-hand side, you can see here long-term flows, same number, same that we just described earlier, same metric for Ben. You see how the net there is moving towards a positive, and last quarter it was actually positive. So look how it was down in the same range as T-Row, losing around $20 billion, and then it moved to actually a net positive last quarter. That's a nice trend there. That's moving upwards. Why? Well, they provide you these same numbers across their different asset classes. On the right, you see fixed income and equity. What's the total outflow for both those? We should be able to read this. Well, we say long-term net flows for fixed income minus $3 billion, okay, for equity minus $3 billion too. So $6.1 billion minus. Well, the other two asset classes must have had positive of about $6.3 billion for them to have a net of 0.2 positive. Here we go. Let's take a look. Sure enough, look, there's alternative at 4. There's multi-asset class at 2.3. Those are positive inflows, right? You net that out, and what do you get? 0.2. That's the growth that they saw last quarter. This stuff is pretty easy to follow. So if you're invested in one of these firms, this is a key metric, among others, that you want to pay attention to. It's a very top-line metric. So Ben, we think, based on that statement where they said their long-term plan is to further diversify their business across asset classes and geographies. Love that. So we think that our previous comments on Ben not properly articulating their strategy, that may have changed. And I think we made those comments 4 or 5 years ago. So we'll probably update that commentary in our Quantigence report for the next update. But just to conclude, the financial sector offers some good selections across subsectors such as insurance, financial services, and asset management, as we pointed out. Our approach was just to take one of each. We picked 3 firms out of that list of 9 and called it good. If we had to pick one of those 9, we think Aflac's too concentrated geographically, Japan, right? And S&P Global doesn't sport a high enough yield for an income portfolio. Looking at T-Row and Ben, 2 asset managers that appear to be very similar, we find Ben to be the more compelling one, and that's not just because we're holding it. So we'll update that note in our report to reflect their clearly stated diversification strategy. Now I'm going to put up another video here for you to watch on dividend stocks. Before I do that, please click the Analyze logo here on the right, subscribe to our channel. Thanks for taking the time to watch this today.